Hello, my name is Justin Wong. I am a senior manager in Deloitte's tax practice and I specialize in the financial services industry. The purpose of this quick tax update is to make sure that you are aware of the new Section 10.1 election in the Income Tax Act, which deals with derivatives on income account. For tax years beginning after March 21, 2017, Section 10.1 permits taxpayers to elect to use a mark-to-market method that applies under GAAP in computing taxable income on derivatives. This election is available to all taxpayers, that is, individuals and corporations. To make the new election, the taxpayer will be required to file Form T-217. The form is due on the same due date as the tax return. This election will apply automatically in subsequent years unless it is later revoked by the taxpayer. While the new election is significant, the big change with the introduction of Section 10.1 is not the right to elect. It's the default rule if you don't elect. A taxpayer that chooses not to elect under Section 10.1 must recognize any gains or losses on derivatives on a realization basis only, unless it is a financial institution. This is a very important change. A simple example. A taxpayer with a calendar year enters into an interest rate swap on July 1, 2018 that settles 1 year later in 2019. On the taxpayer's 2018 financial statements, a mark-to-market loss of $100 is recognized on the swap. Prior to the introduction of Section 10.1, the taxpayer probably could have chosen to either recognize the $100 loss in 2018 or wait until the swap settled in 2019. Now with Section 10.1 in effect, unless the taxpayer elects to use mark-to-market accounting, it must wait until the settlement date in 2019 to report the gain or loss on the swap. All taxpayers with derivatives on income accounts should consider whether they should file the election. However, taxpayers who use derivatives as hedges should be particularly vigilant. Another example, a taxpayer incurs a $10 million U.S. liability that is payable in 1 year. To hedge the foreign currency risk exposure, it enters into a forward contract that settles on the same date the following year. The taxpayer is hedged economically because any FX exposure on the payable is offset by the hedge. However, under Section 10.1, if an election isn't filed, any FX gain or loss on the payable will be recognized in 2018 without being offset by the hedge, which will be recognized in 2019. So as you can see, the consequences of Section 10.1 can be significant. When preparing your next tax return, it is important to consider the election. Your Deloitte tax advisor, or I, or anyone on my team would be happy to meet with you to discuss your particular circumstances. Thank you again for joining us for this quick tax update. Cheers.